93% of people pay way too much in taxes, but it's actually really easy to start saving tens of thousands of dollars on your tax bill. So, in today's video, I'm going to show you exactly how you can save so much money on taxes that it actually feels illegal. But how is that? You see, there are 3 steps that anyone can do to start saving money on their taxes today. Step 1, you have to know your business's profit. Step 2, you have to make sure that your tax structure is correct and fix that. And number 3, you want to build a year-round tax system that helps you save in taxes. But before we get to that, what actually differentiates somebody who saves money on their taxes from somebody who doesn't save money on their taxes? Most importantly, though, how is all this even legal? You see, most people have massively misunderstood the tax code. Because the truth is, the tax code is there to be used in order for you to save if you follow certain steps. Saving money on your taxes is one of the most legal things that you can do if you do it properly and you follow the exact framework that I'm about to go over. In fact, this is the exact framework that I've used with hundreds of clients who have saved tens of thousands of dollars each year. Just look at this particular client here. Before working with us, they were set to owe $43,229. However, after working with us, they only owed $15,673. Pretty good ROI if you ask me. Now, if you want to skip this entire process and just have us save you thousands of dollars on your tax bill, then hit the link in the description of this video to see if you qualify to work with us. So without further ado, let's jump into today's video. Now, before we get into the exact steps, we have to know something that's really, really important. Most business owners don't overpay on their taxes because they're irresponsible. They overpay because nobody really shows them how the taxes or how their tax return actually works. So for the next few minutes, I want to walk down the face of a 1040, the first page of your tax return, because once you see that this is just one big math equation, everything else becomes so much easier to understand. Now, most people probably have never even seen a copy of their tax return or gone over it with their accountant. Most people think that taxes are just some big hocus pocus mystery that we just go back there, we close our eyes, and we say, there it is. That actually couldn't be further from the truth. It really is one big math equation. So I want to walk you through one of our clients' returns. Obviously, I've changed the names, but this is how all of ours looks, whether it's Donald Trump or John and Jane Doe on Main Street. So on your tax return up here, and again, this is straight from the IRS, as you can see, Department of Treasury, Internal Revenue Service. This is just straight from them. I'm taking it right where they do. This first half here, this is what I call demographic information. What your name is, your address, ID numbers. Then next here, we go into what is called filing status. Basically, were you single or were you married at the end of the year? Or were you legally married or legally single at the end of the year? Then you just simply check this box or make an X or a V, whatever it is. Then these are all here. Can somebody claim you as a dependent? Basically, do you live with your parents and do they support you? That's what it's asking. Same thing here, digital assets. This person did not, so we go ahead and mark that. Any kids that you have or anybody that you can claim as a dependent are here. Unfortunately, your dog does not count. Then you just want to check these boxes, make sure they qualify for the child tax credit, so on and so forth. Now, let's go a little bit further here. This entire income section here, this is what I would call, this is a checklist of all of the income that you make. It really is just a math equation. And you want to look here, basically the lines. And again, this is straight from their site. Just goes back into what I talked about in the intro. It is literally a playbook. They will tell you what to do. You want to go with all of your W-2 income. So if you and your wife, or however many taxpayers are on here, have a W-2, you tally all of the income that you made from your W-2 and you simply put it on line 1. And the same thing here. You would go through your W-2 and put those there. If we get next to this next section, these 2 and 3, this is your interest and dividends income. So if you make interest from the bank, if you own stock in Verizon and they pay you a dividend, you would put those numbers here. And this person here, they put that one there. If you had an IRA, if you had a pension, Social Security, you would put those amounts on these lines here. Now, as we zoom out and we scroll down a little bit, it's even more transparent. This line here, this line 7, that would be where your capital gains go. So if you buy and sell stocks, that number there. This line 8, this is where I would say the real magic happens. Now, Schedule 1, it doesn't really matter what that is, but that's where your additional income, basically any type of income that you don't have that fits these qualities, They go on that schedule. Think of business income. And all of your total business income goes on this line here, this line 8. Whether you have one business or 10,000 businesses, all of that number, it's a total of all the businesses that you have, what is called a pass-through entity. You pay taxes on the business profits, whatever you own. You add up your W-2 income, and again, you just follow here. You add up all of these lines, and then you get to your total income, which is $207,997. Now, this is an adjustment here. We're not going to worry about that because that comes from a different schedule, and I don't want to derail us. It's more so the fact that you see how this flows perfectly. And then you get to what is called your adjusted gross income, or AGI, if you've ever heard of that. This person's here was $200,000, 200,319 to be exact. This is the number that all banks look at. They all look at this number. That's how they determine, or a lot of times, what your loan is, like how much you can borrow, things like that. That's why that number is so important. And then if you go to line 12 and 13, these are deductions or things that the IRS gives you to get to your taxable income, what you actually pay tax on. If you are married, or in 2024, you paid 29, or you got a deduction of 29,200. And again, I'm using 24 because the 25 forms have not come out as of this video, but the logic is all exactly the same. Then you get a deduction for your business. Again, that is for a different time and place. But again, we get more deductions. And then you just simply add up these deductions that you get. And then you subtract that from the 200, and you just get your taxable income of $250,000 or $150,000, 381 cents. Now again, or $81. Again, this is super simple, and this is straight from the IRS's site. So when I tell you they want you to pay less taxes or it's a roadmap, it really is. Now, as we go down to the next page, this is how you compute your tax. And again, it really is just a math equation. You would look here on this form. If you are single, you're going to use this box. If you're married, filing joint, you're going to use this one. If you're separate, if you're head of household, you just look at your marital status, which again is pulled from here, married or married joint. And then same thing, you quite simply take the numbers. It's a math equation. You take the amount from line 15. That's all it is. Or first you want to say what your taxable income is. If your taxable income is between 100 and 201,000, you start putting it there. And I pulled this straight from the return, line 15. You multiply this by your percentage, which is 22%. And then you get this number here, and then you simply subtract it, and this is your total tax that you pay. Again, it's a math equation. And again, we could do it for any one of these, but we want to stay married, or on the married example. Now, we go down to line 15, or page 2, and we just simply enter that number in, which again is 23,190, and then you get to subtract your child tax credit. Again, what that is, in 2024, you got a $2,000 deduction or credit for each child that you had. This person had 2, and then you simply just subtract it. So now your federal income tax is $19,190. Your self-employment tax, which is something different, we'll get to that in the later part of this video. And then you just simply add this up and you get all of your tax. And then you take all of your withholdings. So we want to save. Same thing in your W-2 job. For all of us that have worked here in the US, when you get that, you end up, let's say you make 100,000, but you actually take home 80,000. That $20,000 difference, those are all of your withholdings. You put that there, and then you come down to this. You come down to this number here, and it literally is subtracting it. You subtract the 12,000 or 12,703 from this number here, and then whatever is left over, that is what you pay. And again, I say this, it is simply a math equation. A lot of people think taxes are hocus pocus. It really is a math equation. And again, there is nothing mysterious about it. It really is just a math equation. It's addition and subtraction and a little bit of multiplication. It really is just a calculator. And now that we understand that taxes are just math on a page, kind of like arithmetic, the rest of this video becomes so much easier to follow because everything I'm about to show you really ties into how your 1040 works. So now let's get into the actual first step that we talked about way up here, was you have to know your business profit. Now, we might wonder, what exactly is your business profit? Because we all hear that term. And knowing your profit as a business owner, this is the foundation of your tax, or not your, well, your tax return, of your tax strategy, because that is what the IRS taxes you on. They tax you on what is left over, not the money in your bank account, not the amount of money that your clients pay you. It's what is left over that you need to make all of that. So again, we have to understand what the profit is. Now, the way that we determine our profit is through bookkeeping. However, most of us have messy bookkeeping, and I'm sure you can relate to this picture of this guy. Most of it is messy. And what do I mean by messy bookkeeping? Is that most of us have, or most business owners, they start out, they're using their personal account, a little bit of their business account, and they just really don't have everything under control. You want to make sure that your books are clean, making sure that everything is organized. You're not mixing personal and business expenses. And I always tell people, make sure that you actually hire a competent bookkeeper. When you're first just starting out, you may not have it in the budget, but once you're making a good amount of money, over 20 or 30,000, that's when you want to hire somebody to do this, because they can at least set this up right and help you automate it. But when you're first starting, it feels like you're swimming upstream. Now, I want to show you again, to get back to this, the IRS, how they basically do this and how it really is just a playbook, is let's look at a tax return. Now, again, this is that same client's business tax return. And again, it's not so much that you have to know every single type of business return. It's more that they all work the same. Now, as you guys can see here, this is what is called a Schedule C, is again, profit or loss from your business. And again, this looks exactly like, or very similar to the front page. The name of the owner, the proprietor, what type of business you have, your ID numbers. This is all exactly the same. Now, what one thing is different is W-2, like as we talked about up here, and as we've all had, W-2 only reports the actual income that you make. You are not allowed, or not that you're not allowed, there are very few deductions that you have. So if you have to spend any money to make that W-2 income, the deductions you have are very limited. Now, let's go back to what we had earlier, or what we're about to go over, is your profit and loss, which obviously this income is very similar, right? All the money that you make, the 231, 347, that's their total revenue. Whatever somebody paid them to do in their business, that's what they got. But now, as we talk about here, is that you can scroll down a little, or as we scroll down, is you get to deduct your expenses. The IRS is literally telling you, please tell us what you spent on things like advertising, contract labor, insurance outside of health, legal fees, all of these expenses. In order to earn that money, you had to incur expenses that you paid. It could be things such as office expense, supplies, deductible meals, utilities, wages, all of this stuff. You get to deduct all of that stuff. And again, this right here for the IRS, again, we're just following this. And again, let's say you don't see your specific expense. For example, maybe you rented some equipment or you had software. If that number isn't there, you can simply use this other expenses line. That's where everything else goes. And again, I want to zoom in here, is you get your total expenses, which come out to $119,000 or $119,034. And then this is your profit. And again, using the IRS's own words, you get to pay taxes on your profit. These are all of your expenses. This is everything that you get to do. And this is why it is so important to have your bookkeeping, because if you do not know where your money is, it is going to make filling out this form incredibly difficult. You have to know what you're bringing in and also what you're spending. Again, we're just using the IRS's own logic and rules against them or for them. Now, again, this is step one. You have to know your profit, why it is so important, and you have to know your books. You have to be organized, because I can tell you, if you know what you're taxed on, now it makes things so fundamentally easy. Now that we understand that profit is the most important thing that we have to know, because it really is the foundation of everything, is now we want to make sure that we are fixing our structure and you're paying yourself correctly. Now, when you are self-employed as a business owner, you get to say, like this guy here, the taxes are too damn high. I believe this was a political party movement quite a long time ago, where he said our tax should be lower because they're high. And I agree with that. However, when you are a business owner, you get to actually select how you are taxed, or your entity. going back to, you want to make sure that you're fixing your structure and doing this correctly. So we have to understand a few things, is that everybody is going to pay federal income taxes. It was that number that I showed you, I believe is on line 16. Those are your federal income taxes. And then you have what are called your state taxes. Now, again, every state's going to be a little bit different, and I'm not going to go through 41 states that charge income tax. I'm not going to go and do all their tax returns like I did. But everybody pays these two taxes, your federal taxes and your state taxes. However, number 3 is what is called your self-employment tax. I'm going to scroll back up. This is roughly 15.3% of your profit. Now, if we scroll back all the way back to this return, you guys will see what this is called. It is called your self-employment tax. This, and I'm going to erase this so it's a little bit easier, this $15,000. Every year as a self-employed person, you have to pay 15.3% in taxes, or self-employment tax. Those are your Medicare and your Social Security. You have to pay that on your profit. And that is, as we go back to our buddy who was part of the taxes are too damn high movement, you're going to feel that way. You are going to feel that your taxes are super high. However, there is a way to get rid of that. It is what is called the LLC versus S Corp argument, or the S Corp strategy. You actually get to tell the IRS, hey IRS, I know that I started as this LLC and I pay that nasty self-employment tax. I actually want to be taxed as an S corporation, this one here. And all you're doing is that you're telling the IRS is that I want to be taxed as an S corporation. Now we might be wondering, what exactly does that mean? Do I have to start a new business? Do I have to redo this thing? No, you do not. It is just a form that you fill out. It's called a 2553. And I don't want to hammer you guys here with forms, maybe make a separate video for that. Is you just fill out that form and you tell the IRS, I want to be an S corporation and I want to get rid of that. Now, let's do a few drawings here. Kind of what that is as we were originally, our original profit was $111,000. 369 or sorry, $111,369. Now, before, as you guys saw that, you're paying roughly 15%, which was, we'll just call it, I believe it was, without going up, about $15,800. When you are an LLC and you do not elect to be taxed an S Corp, you owe $15,000 in self-employment tax. However, if we just go back and using the IRS's logic against them, you still have that profit, that still changes. However, now you do not pay, you pay 0% of self-employment on that. And now you have almost just cut this in half. However, it's not quite that simple. It's not a get out of jail free card because this would be 0. So it's not quite that. What ends up happening, let's take our profit of $111,000, 369, actually I think I drew that wrong, is you have to split some of that into what's called W-2 and distributions, or we'll just call it DIST for now. Now, as we zoom out a little bit here, you have to split these into 2 buckets. Now, you have to split this by what somebody would pay you to work in that job versus what you would pay somebody to take over your job. So in this example, let's say that this person, they ran a construction business, and if they were going to hire a construction manager to take over their job, let's say it was $50,000, you would have to split that income. So now only half of that is taxed at 15.3%, and for lack of rounding, let's just call it $7,000. This distribution, all the money that you make, that portion would be less that. So if my math is correct, that would be 61. Let's call it 61,000 just for easy math. So now that one has 0% self-employment. And that's 0. So right away, just in having the correct tax structure, you only pay $7,000 in self-employment. instead of what was this original person's, what was their original one? I believe it was almost $15,000. So just by having the right tax structure, you would go from paying $15,000 to $7,000. That's a pretty good ROI just right there off the bat. Now, if we go back to this LLC versus S Corp drawing right here, is that you might ask, well, why wouldn't we do this at 10,000? Why wouldn't we do this at 30,000? I always tell clients until your profit is at least 80,000, you don't want to go through all this. The reason is that you have more administrative fees. You have to have a separate business return at this point. You're going to have to do payroll. So there are more fees. So while you might be saving $7,000, you're probably going to pick up somewhere between $2,000 and $3,000 in extra admin fees, and that number starts to get cut in half. So if your profit is $10,000 and you say $1,500, well, now I've just picked up $2,000 in extra tax return fees. That doesn't really make any sense. So we want to make sure that this is economically feasible. But as you guys can see, just doing steps 1 and 2, getting your books in order and making sure you're in the correct entity, that's going to save you so much money in taxes. Now, the next thing that we want to do is we want to have what's called a year-round tax strategy, because this is where the smarts is. This is kind of where the secret sauce is. So we want to be like this guy here. I'm sure we've all seen this meme, is that we want to be smart. We want to be thinking year-round. And we want to be looking for other deductions that they move the needle, but it's already things that we are kind of already doing. Because if we scroll up to this one here and we look at our profit, the Schedule C in this example, this is all of our business expenses. We're going to spend this money regardless. We're going to only spend this money if we have a business. For example, if our business went away, we're not going to pay for advertising, right? So these are things that we have to spend. There's no way getting around it. However, what we want to do is that we want to be smart like this guy, right? And again, we want to look at for things that we are already paying for, right? All of us here, we live in a home. Or most of us do, unless we're camping full time. Just ask people in downtown LA or other cities. We want to be smart. Now, this picture here, this is what is called a home office, right? All of us have a home office. I work from home sometimes. I have a setup that's for home ever since COVID. Now, as a business owner, you get to write off this space or you get to lower your taxes. The reason why I love this one so much and you want to have a year-round strategy is you want to make sure you're taking advantage of this, because these are expenses that you're going to have no matter what. You are always going to have that. You're always going to have a place to live. You're always going to have to pay property tax, all this stuff. We want to use this as an example. And again, staying on this theme of using what the IRS tells us and how is a playbook, it is literally a playbook. There is no hocus pocus. This is the form that you would use to write off your home office. Now, again, each return is going to be a little bit different, but it's more so that you guys see that this is in the tax code. I'm not telling you guys anything crazy. Expenses for business use of your home. This is straight from the IRS's site. And it tells you, one of the big things though, is that this space has to be, and you'll see it here. I mean, you just fill it out on the form. Area, this one here is very important. It's exclusively used for business, regularly for daycare, so on and so forth. What that means is it has to be a room that is specific for business. Now, as you guys can see here in this picture, as I go up, this is exclusive business use. There's a camera, there's a computer, a light, a bookshelf for stuff. This is clearly for the business. It cannot be your living room. It can't be the kitchen table because you guys eat there. It has to be a space specifically for business. And as you guys see here, I mean, this really is a playbook. You just enter it in. What's the total area of the home, right? It's 1,000 square feet. It's 50, and again, I'm just using easy numbers, 150 square feet. So that means 10%. It means that all of the expenses that you have for running your home, and again, I'm just using easy ones. Think of things like rent, repairs, utilities. You get to deduct that. So, and you just put in the total amount. So if you paid 18,000, if you paid 108 for insurance, if you paid for some utilities, all of that number here, again, it's very simple. It is literally just using these forms. These are straight from the IRS. And then you get to deduct that. You get to pay less in taxes. And again, I'm always telling people you want to do things that you were already going to do. You were going to pay rent or mortgage. And again, I'm just using it as an example. So you guys see it. These are forms that you use. The IRS, it really is a playbook. Now that we're writing off our home office, the next thing that we want to look at is our kids, right? This makes sense. We all have kids. And as you can see, one of the things that the IRS allows you to use, and I'll actually scroll back up so you guys can see this on the form, is the IRS or Internal Revenue Code. You can actually deduct wages. For example, wages here. You can, now part of that is you get to deduct people who work for you, but let's look at things that we're already doing. All of us, we have kids, or I know I had kids. I had an allowance and I had to do certain chores like take out the trash and clean places, and I would get paid from my parents. However, they did not get to deduct it. However, let's go back to this, right? You can hire your kids to work inside of your business. Now, obviously, you can pay and they have to actually have legitimate jobs, meaning they actually work with you, you pay them a wage, has to be reasonable, right? You can't just pay them $30,000 because they share your DNA. You have to pay them for actual things that you can do. Now, some of us here, we hear about modeling on Instagram, and that's really hard, and that's very hard to do. One of the things that I like to have all of my clients do, and this is it. Let's go back to this home office. If we see here, I think, let's pretend that's a trash can, right? And there's stuff on here. Maybe you can't see it as well. What if you paid your kids, instead of paying your kids an allowance to clean the home, maybe you pay them a wage to clean your home office. And again, you would just pay them like you would pay anybody else. Now, I want to show you guys an example of this, how this would actually work. Now, again, on here, this is the same profit and loss that the same people had above. But let's add some expenses. Let's add that $10,000 in expenses that you moved from paying your kids personally to paying them in the business. Now, the next thing that you want to do also, you get to deduct your home office, which is a little bit different. So now, if we scroll back up to the original return that these clients had, their original profit was $111,369. But what if we now just rearrange the way that we paid people and did things? So now, without having to spend extra money, our taxable income just went down $10,000 just from paying our kids. Instead of paying them to do chores, we paid them to clean our home office and other stuff. Now, that same money that wasn't deductible is now deductible. And that is what smart year-round tax planning is, right? Now, the reason that worked is we had to know where we were. That is what a year-round tax planner would be, to make sure. Now, the next thing that we want to do is what is called retirement income, right? IRA, Roth, 401k, all of these are the same, but it still lowers your income. Now, the reason why I like this strategy so much is while in the S Corp strategy, you do get to deduct or eliminate that self-employment tax or severely reduce it. But that self-employment tax goes to things like Social Security and Medicare. So now that you are not putting money into Medicare into Social Security, we have to fund it ourselves. And this amount of money, this is also deductible. You can put away $7,000 for an IRA or $7,500, $70,000 for an 401k, Roth. It's not so much we have to go into each individual one, is that you guys can see in this example, and again, it is deductible, is that if we are going to do that, if we just found a way to cut our bill or cut our profit from 110,000, you have now just put that to 101. Now the same thing works here. If you put money, your taxable income goes down. And again, I'm not going to go over each form because as you see, we're pulling it directly from the IRS. We want to make sure that we're doing these things because you are already going to put money away. You're already paying Social Security tax. Well, now let's just redirect it. Instead of paying a Social Security tax, let's put that money into our retirement accounts and let it grow tax-free. Now, the bonus one is, as you can see here, this guy here is traveling in style. Now, again, I don't know if we all have to travel first class. Some of us do, some of us don't. I think it's personally a waste of money, but that's just me. But this guy is traveling with a purpose. He's traveling first class. But what else could that do? Let's say that we wanted to travel for business. Well, what we can do is we can just be strategic about our traveling. For example, Maybe if we have family in a certain area, why don't we try to find a conference or a reason to travel there for business and also visit our family? Now, again, I want to show you guys here on this tax return, one of the line items that you get to deduct is what is called travel. Literally right here. You get to deduct your travel. And if you find more expenses, this number goes down even further. So again, we want to be doing things with a purpose. And most importantly, we want to be looking for stuff that we're already going to do. We want to travel we want to travel to see our family, to go places. But now we just have to find a business purpose. Just like how we want to pay our kids. Again, when we do here, we pay our kids an allowance and then our profit goes down. It's the same thing here. You can add your travel, all of this stuff. All of this is perfect. And this is what I call year-round tax strategy. You guys can do this. This is not rocket science. Anybody can do these things. And again, all of this stuff can be accomplished by anybody, and that is what we do for our clients. So again, I want to review this to kind of put a bow on this. Where all of this comes back is it comes back to these three things as we talked about here in all of this. Knowing your profit, fixing your structure, and building a year-round tax system. And that is where the real money is made in taxes. You have to know that this is all in the tax code. There's no mystery. There's no loopholes or anything. This is literally how it works. As I showed you guys, it is on the tax return. They tell you. And now I want to go back to this particular person here. And again, this person who went from $43,000 to $15,000, they followed all that stuff. We made sure their books were in order. We got that squared. We made sure they were in the correct tax entity election. And then we just helped them take advantage of things they were doing. That client, they were already paying they were going to pay their kid. Their son was already working with them. He just hadn't done it in the past. So he paid him. And then he opened up a simple IRA, which is a little bit different, but the same idea. He put money away. And again, if you want to go from saving $43,000 to $15,000, you literally put those things into existence, and I promise you it will work. And again, if you do want to work with us, click the link in the description of this video, apply to work with us, and we will hopefully get you on a very similar path. And I will see you guys in the next.